Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the Infrastructure Value Fund and the Global Infrastructure Income Fund from the ClearBridge team under Franklin Templeton. I covered the X-Trackers MSCI World Utilities UCITS ETF and the 91 GSF Global Natural Resources Fund recently as potential ideas with a defensive style or low correlation to broad global equities to consider for volatile market conditions. Another popular sector to consider for similar reasons is the infrastructure sector. Broadly speaking, infrastructure and utilities and resources are all considered defensive equity sectors that tend to be more resilient during tough market conditions, but in exchange provide lower long-term returns compared to the more exciting growth equities such as technology sector. Utilities primarily cover the companies that provide electricity, gas, and water management and provision, as well as sewage management. Utilities is generally a subset of infrastructure, which also includes transportation infrastructure such as airports, maritime ports, railroads and toll roads, communications infrastructure, and also community and social infrastructure buildings. Resources, on the other hand, is a slightly different sector, mainly covering the production, transportation, and associated services of resources that include traditional energy such as oil and gas, renewable energy, base and precious metals, rare minerals, and agriculture. Practically speaking, there will be some company overlaps in utilities funds and resources funds, because some energy conglomerates are producers and managers and providers all in one. That being said, the actual performance of each active fund can be very different, depending on the specific exposures in their respective portfolios. So when I came across the Infrastructure Value Fund and the Global Infrastructure Income Fund, both from FTGF ClearBridge, I thought it would be interesting to find out what is the difference between the two funds coming from the same fund provider and having what seems to be a pretty similar fund name. So let's find out more. Talking about this fund provider is like going through a history of mergers and acquisitions. The team that manages the two funds covered in this video is originally an Australian-based boutique manager called Rare Infrastructure, founded in 2006 that focuses on global listed infrastructure fund solutions. In 2015, leggmason, a US-based multi-boutique fund provider founded in 1899, acquired majority stakes in Rare, and therefore Rare became one of the boutique franchises under leggmason while still managing Rare branded funds. One of leggmason's other boutique manager is ClearBridge Investments. ClearBridge was originally Citigroup Asset Management and was acquired by leggmason in 2005. In 2019, leggmason integrated Rare and ClearBridge together and rebranded all Rare products into ClearBridge branding. In 2020, Franklin Templeton Investments, a US-based global asset management firm, acquired leggmason. Franklin Templeton itself is a result of a merger in 1992 between Franklin Distributors Inc. and Templeton, Gabriel and Hansberger Limited. After the completion of the acquisition, the leggmason branding ceased to exist. Franklin Templeton chose to retain the ClearBridge branding that is now one of the many subsidiaries of the Franklin Templeton business. This explains why the fund names are so long, and as well as the reasons for the renaming of the funds in the past if you came across the information. It is also important to note that the key personnel of the original Rare team are mostly still intact and still based in Australia, specializing in listed infrastructure investing and still running these two funds. Both the infrastructure funds in this video are each co-managed by 4 persons. Nick Langley, Shane Hurst, and Charles Hamieth are present in both funds. The FTGF ClearBridge Infrastructure Value Fund additionally has Simon Ong, while the FTGF ClearBridge Global Infrastructure Income Fund has Daniel Chu. All 5 of them are from the Rare Infrastructure team. Nick is one of the co-founders of Rare Infrastructure and a senior portfolio manager with 30 years of industry experience. Shane has 28 years of industry experience. And so does Charles as well. Nick, Shane, and Charles co-manage the Infrastructure Value Fund since its inception in 2016. Simon has 16 years of industry experience and moved up from a senior portfolio analyst while in Rare to a portfolio manager role in 2021. He joined the co-management of the Infrastructure Value Fund to replace Richard Elmsley, who is another co-founder of Rare. The Global Infrastructure Income Fund is newer, having incepted in 2021. Nick, Shane, Charles, and Daniel co-manage the fund since its inception. Daniel has 17 years of industry experience. Both the Infrastructure Value Fund and the Global Infrastructure Income Fund are sub-funds under the Franklin Templeton Global Funds plc, or FTGF in short, fund family. FTGF is set up as an Irish ICVC company structure and is UCITS qualified. Singapore-wise, both funds are registered as MAS recognized schemes, which means they are suitable for retail investors. Now let's find out more about the strategies of both funds to try to figure out what are the differences between the two. Here is a summary objective found in the web pages and fact sheets of the two funds. The Infrastructure Value Fund states it wants to achieve long-term growth that includes income from dividends and interest, plus capital growth. The Global Infrastructure Income Fund states pretty much the same. Both funds also indicate their main equity exposures will come from infrastructure companies in the G7 countries, but can also go beyond that to other developed and emerging market countries. So, no difference here again. The investment objectives in the prospectus is broadly similar, with the exception that it states for emerging market country exposure, there is a 25% cap for Infrastructure Value Fund and a 20% cap for Global Infrastructure Income Fund. I don't think this small difference will lead to anything significant. There is also one additional last sentence for the Infrastructure Value Fund that I'm not sure what it means. What is interesting though is that the prospectus categorizes the Infrastructure Value Fund under the Equity Funds list and the Global Infrastructure Income Fund under the Equity Income Funds list. Does it mean there is a notable difference in the distribution yield between the two funds? We'll find out later. Digging further in the prospectus, there are fund-specific supplement documents that give additional details. For both funds, it is elaborated that the intended infrastructure investments cover utilities, transport, communications, and as well community and social infrastructure. This is followed by a detailed description of the stock selection criteria. Interestingly, it is stated that the estimated investable universe is 200 companies for Infrastructure Value Fund and 175 companies for Global Infrastructure Income Fund. I'm not sure why the universe has a different size when the selection criteria looks identical. For both funds, the investment approach essentially combines top-down macroeconomic view with bottom-up stock selection through fundamental analysis. The stock selection criteria can be broadly summarized as market leaders in their respective infrastructure segments with well-established infrastructure assets and have stable cash flows and earnings. There is a long section on ESG that is identical for both funds. While the gist is that ESG is well integrated in the investment process, I think a separate explanation document is probably needed to really understand how the ESG factors work in the funds. There is also some elaboration on the initial stock screening process that filters down an initial list of around 600 companies using liquidity, infrastructure exposure, and infrastructure quality scoring. Additionally, it is stated the investment horizon taken by the team is a 5-year holding period view. This results in an eventual portfolio of 30 to 60 positions. These are identical descriptions for both funds. For both funds, they are allowed to invest in ADRs and GDRs. They can also invest up to 20% in public REITs and up to 10% in other mutual funds. The Infrastructure Value Fund additionally has a paragraph stating it can invest up to 10% in China A shares. I don't think this will lead to any significant difference though. Finally, for both funds, the stated benchmark index is the FTSE Global Core Infrastructure 50/50 Index. However, this benchmark doesn't really mean much, as the funds have a different returns target objective, that is the OECD G7 Inflation Index plus 5.5% gross of fees over the long term. It is not defined what long term means, though we would normally take it to refer to over a market cycle, which can be many years. So as long as the funds can meet the returns target, it doesn't matter if the funds have a very different portfolio construct or have a very different returns movement compared to the benchmark. The benchmark was actually originally the same as the returns target objective, that is the OECD G7 Inflation Index plus 5.5% gross, but it was changed to the FTSE Global Core Infrastructure 50/50 Index in October 2024. It is puzzling why this was changed. This is an important paragraph to take note as we look at the fund's performance later. Now, while there are some small differences in the stated investment strategies, there doesn't seem to be anything that clearly differentiates the two funds. Let's go through the fund portfolios next to see how they compare. The Infrastructure Value Fund is the older fund that was incepted in 2016. The fund is base currency in euro, as European infrastructure sector was probably more developed back then and had a broader universe to invest in. In any case, the fund has US dollar hedged share class, so the base currency is not a critical issue. The fund currently has over 700 million euros of AUM. The Global Infrastructure Income Fund is a newer fund having incepted in 2021. The base currency is US dollars and the fund AUM is near 300 million US dollars. On geographic allocation, North America that covers US and Canada comprise about 50% of the portfolios, and the other half is mostly Europe countries. Australia and Brazil are the exceptions, though they are very small exposures in the portfolios. There are some visible differences between the two funds in specific country allocations, which is likely the result of differences in the specific stock exposures. On sector allocation, while electric covers nearly half the portfolio in both funds, the rest of the exposures have some clear differences. The Infrastructure Value Fund has a much higher exposure in rail, airports, and toll roads, suggesting more focus on transportation aspects. The Global Infrastructure Income Fund has a much higher exposure in gas, and as well as some small exposures in communications infrastructure and renewables. On market cap allocation, both funds look similar, with only about 23% in smaller companies and the rest are in larger names. The Infrastructure Value Fund currently has 32 holdings, while the Global Infrastructure Income Fund has 35 holdings, so both funds run a pretty concentrated portfolio. The top 10 positions do show that there is some form of soft limit on individual position sizing at around 5%, and also show a high overlap between the two funds. The fund web pages allow for downloading of the full holdings so we can grab the data and compare the differences. Here are the list of holdings that are unique to each fund. For example, the Infrastructure Value Fund holds more transportation-focused companies like Canadian National Railway and Ferrovial, while the Global Infrastructure Income Fund holds more gas-focused companies like Enbridge and Italgas. After browsing through the portfolio of the two funds, we can see that the fund strategies are broadly similar, but somehow the resulting portfolios in the two funds ended up slightly different. At this point, I can't really find any meaningful explanations. Both the Infrastructure Value Fund and the Global Infrastructure Income Fund have a long list of share classes catered for different investor types, currencies, and distribution types. For this video, we will focus on the retail A share class in US dollars and Sing dollars trading currencies that are more commonly used for Singapore-based investors. The Infrastructure Value Fund is Euro-based currency. Therefore, both the US dollars and Sing dollar share classes are currency hedged. The Global Infrastructure Income Fund is a US dollar-based currency. Therefore, only the Sing dollar share class is currency hedged. There is not much elaboration on the hedging strategy for the funds though, so we do not know whether they are applying a full portfolio hedge or a partial portfolio hedge. Partial hedging is more common for equity funds in general. Other retail A currency classes available include Euro, Sterling, Aussie dollars, CNH, and Hong Kong dollars. The retail A share classes for both funds has a management fee of 1.5%. Adding other expenses gives a total expense ratio or TER of around 1.92% to 1.95%. Franklin Templeton can give up to 85% of the management fees to distributors as trailer fees. The funds allow for up to 5% subscription fees, though I think anything more than 2% for mutual funds is excessive. The US dollar classes come with both accumulation and distribution options, while the Sing dollar class is available only in distribution option. The distribution classes are all monthly distributing frequency. The plus wording means that the distributions are not purely from natural dividends and coupon income from underlying positions, and the fund can reduce capital to top up to the distribution to be paid out. The Global Infrastructure Income Fund also has a plus E share class, which essentially means that the distributions are from natural dividends and coupon income from underlying positions, although some capital is used to cover the fees and expenses. This means the plus share class will typically have a higher distribution yield compared to the plus E share class. It was difficult to find out the distribution yield of the respective share classes, as I couldn't find the data in the Singapore website or Singapore documents. I ended up going to the Franklin Templeton's Ireland website, where it provides full dividend history of each share class, and manually calculated a 12-month distribution yield by summing up the past 12 months of distributions, then divided by the indicated NAV of the last distribution. You can also see from this screenshot that the distribution amounts are different every month, so the funds do not provide a smoothened fixed distribution amount. So here are the calculation results of the distribution yields. Comparing the plus US dollar share classes, we can see the Infrastructure Value Fund has a 5.26% distribution yield, which is slightly lower than the 5.98% of the Global Infrastructure Income Fund. However, I don't think the investment team needs to run two separate funds just for this small distribution difference. Comparing the plus US dollar and plus E US dollar classes of the Global Infrastructure Income Fund, we can see about 1.8% difference, which is close to the TER of the fund. The interesting difference in the two funds comes when we compare the US dollar and Sing dollar share classes. For the Infrastructure Value Fund, the Sing dollar class has a distribution yield lower than the US dollar class by about 1.4%. Which is likely due to the currency hedging cost that has been applied into the distribution and is a common practice for many funds. However, looking at the Global Infrastructure Income Fund, both the US dollar and Sing dollar share classes have around the same distribution yield, which means the currency hedging cost would have been factored into the NAV instead. I can't find any details or explanations on this from Franklin Templeton's websites or documents, but this would be something important to note, especially for Sing dollar investors. To make it easier to compare funds and share classes, I have tabulated the calendar year and annualized returns of both funds as seen here. I have used abbreviations for the fund name and share class descriptions for convenience. The Infrastructure Value Fund's share classes were incepted in 2017. So there are several more years of performance data compared to Global Infrastructure Fund, which was incepted in 2021. The returns data for the FTSE Global Core Infrastructure 50/50 Index in the fund web pages seem to be currency adjusted, but in an inconsistent manner. So I use a standardized set of data direct from the index factsheet itself. I have also added the MSCI World Index performance so that we can get a feel on how different infrastructure sector compares to broad global equities. Let's first take a look at the Infrastructure Value Fund. Looking across calendar year and annualized returns, there is a strong correlation to the FTSE Global Core Infrastructure 50/50 Index, which means if you are indeed looking for an infrastructure exposure that can deliver similar to this index, the fund is able to deliver it. The fund also appears to have a slightly better performance than the FTSE index for 3-year and 5-year annualized periods. Additionally, the fund was able to deliver a positive return in 2022 when the index was negative. On the other hand, year-to-date return looks to be lagging behind the index a bit. But remember, the fund has a target return objective, that is the OECD G7 CPI plus 5.5%. The Infrastructure Value Fund looks to have met the objective on a 5-year annualized basis, but not for a 3-year period. Again, the fund did not define the assessment period to meet the objective, so this is something that can be disputed. Comparing the US dollar and Sing dollar share classes, we can see that the Sing dollar share class has around 1% per annum lower returns over the long term. This would be roughly the currency hedging cost to expect. Now, if we look at the Global Infrastructure Income Fund instead, some strange observations can be found. While the fund has a shorter track record, the calendar year returns look significantly different compared to both the Infrastructure Value Fund and the FTSE Global Core Infrastructure 50/50 Index. 2022 and 2024 were significantly worse, and year-to-date is significantly better. For two funds to have about 2/3 of similar portfolio exposures and with similar investment strategies, this big difference in performance is really puzzling. However, the only way to figure out the reasons is to deep dive into each of the holdings' returns and their entry and exit timings, which we will never be able to do as retail investors. Here is a cumulative performance chart from Morningstar comparing the two funds. The Global Infrastructure Income Fund seems to be slowly widening the underperformance gap over time versus the Infrastructure Value Fund. Looking at 1-year chart, we can see that the very strong year-to-date returns of the Global Infrastructure Income Fund is mainly due to the much lower starting base at the start of the year, trying to play catch-up for its underperformance in 2024. Another interesting observation is seen when I throw in the 91 GSF Global Natural Resources Fund and the Xtrackers MSCI World Utilities Uses ETF, both that I've done videos on recently. It appears that the Global Infrastructure Income Fund is highly correlated to the Xtrackers MSCI World Utilities Uses ETF through its full track record. This suggests the Global Infrastructure Income Fund might have been heavily overweighted in utilities stocks instead of more diversified across the infrastructure universe, resulting in the performance track record it has. In this case, I would probably pick the ETF if I really want to get a purer utilities-focused exposure. Finally, we revisit the performance data table and take a look at the infrastructure sector versus the broad global equities represented by MSCI World Index. The first observation is that during bearish market conditions, infrastructure sector tends to be quite resilient and has only small drawdowns, or at times have actually positive returns, making it a potential candidate for reducing risk in global equity portfolio. The second observation is that as a defensive sector, there are times where it significantly underperforms, especially in a high-growth bull market. This means that similar to the more specific natural resources play and utilities play, investing in infrastructure should also be mainly either used for long-term defensive equity allocation if you are satisfied with its lower returns, or used for active and timing-sensitive deployment into a portfolio during volatile markets to try to reduce equity drawdowns in the portfolio. The good thing is that the Infrastructure Value Fund has a slightly better performance track record than the FTSE Global Core Infrastructure 50/50 Index, making it a viable active mutual fund to consider. With that, let's summarize our findings and start first with the FTGF ClearBridge Global Infrastructure Income Fund. The fund managers originate from BRAD, a boutique investment team specializing in infrastructure sector. The team has been working together for many years, providing stability in the investment approach. Investment strategy provided is detailed, and the implemented portfolio looks decently diversified. However, the separation of the fund benchmark and the fund's returns target objective is confusing to investors. Performance is a key concern. While the track record is relatively short, it has very different returns compared to the benchmark. It is difficult to consider this fund as a representation for infrastructure sector exposure. Additionally, it can be observed that the fund's performance is more similar to utilities sector instead. Though without a clear outperformance, it would be more practical to pick a utilities sector ETF. Sing dollar investors will need to take note that the Sing dollar share class appears to give a high distribution payout yield, but is sacrificing the NAV to achieve that. In conclusion, this is not a fund I would consider for infrastructure play. Next, let's summarize the FTGF ClearBridge Infrastructure Value Fund. Besides the same first 3 points, this fund has a much longer track record. Returns are more similar to the benchmark, and it has exhibited outperformance over time. While the distribution yield of the US dollar share class is slightly lower than the Global Infrastructure Income Fund, it is still decently high at around 5% levels, making it a suitable consideration for investors looking for income play despite the fund not categorized under the equity income funds. One potential area of improvement would be to increase subsector diversification into areas such as communications infrastructure and renewables that are absent in this fund's portfolio but present in the Global Infrastructure Income Fund. Of course, this should only be done if there are attractive and suitable investment ideas. In conclusion, with a much better performance track record and better alignment to the benchmark, I think this fund is worth considering for infrastructure play. In the end, the mystery remains unsolved. Why did the investment team create 2 funds with near identical investment strategies, but ended up with different portfolios and with very different performance track record? If any of the viewers have a chance to meet the investment team, please do us all a favor and ask this question to find out the answer. This concludes my absolutely biased comments on the Infrastructure Value Fund and the Global Infrastructure Income Fund from the ClearBridge team under Franklin Templeton. If you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.